Understanding the Genius Act, implications for stablecoins and the crypto market. Use a shocking truth. The crypto world is on the brink of a seismic shift, and it's not because of a new blockchain breakthrough. It's because of a law. A 48-page document called the Guiding and Establishing National Innovation for U.S. Stablecoins Act, Genius Act, that's quietly reshaping the future of digital money. But here's where it gets controversial. While many are hailing this as a victory for innovation, the reality is far more nuanced. Let's unpack why this legislation could either stabilize the crypto economy or stifle its most radical ideas. And this is the part most people miss. The act isn't just about rules. It's a power play between traditional finance and decentralized ecosystems. The Genius Act is the first major U.S. law to directly regulate stablecoins, crypto assets designed to hold steady value, often pegged to the U.S. dollar. On paper, this looks like progress. For blockchain startups and DeFi enthusiasts, it's a sigh of relief. But hold on, the devil is in the details. The law creates a two-tier system. Federal oversight for stablecoins exceeding $50 billion in circulation, and state-level regulation for those under $10 billion. Think about this. Major players like Circle, issuer of USDC, already exceed the 50B threshold. Yet under current rules, neither USDT nor USDC qualify as payment stablecoins because they're not physically used for everyday transactions. Instead, they're parked as stable value anchors in volatile crypto markets. This loophole reveals a critical flaw. The law assumes stablecoins will function like cash, but their real-world usage defies that assumption. Now let's talk about the elephant in the room: compliance. The Act mandates that stablecoin issuers must freeze, burn, or block transfers based on a lawful order. For decentralized protocols like ERC-20 stablecoins, this is impossible. These systems are built on trustless, permissionless code. Requiring them to comply with government orders clashes with their core principles. The result? Non-compliance could lead to daily fines or imprisonment. This isn't just a technical hurdle, it's a philosophical war. Should a technology designed to bypass intermediaries now serve as a tool for centralized control? And here's the twist. The law doesn't even define what a lawful order entails. That ambiguity is handed over to a mysterious Stablecoin Review Board, giving regulators free rein to shape rules retroactively. Sound flexible or dangerously vague? Then there's the money-making side of stablecoins. Most issuers don't pay interest to users. Instead, they profit by holding low-risk assets like U.S. Treasuries and issuing stablecoins at zero cost. This is textbook yield farming, making money off other people's money. Tether, for example, generates billions in revenue per employee, rivaling illicit industries. But what happens if interest rates turn negative? The profit margin evaporates, forcing issuers to hike fees or risk losses. The Genius Act doesn't address this. It also ignores a bigger risk: the lack of FDIC insurance. If a stablecoin collapses, retail investors could lose everything in minutes. Remember the SVB bank run? Now imagine that scenario playing out in crypto. The Fed might step in, but can it handle a digital panic? So, who benefits from this law? Traditional banks and institutions with existing charters. That's who. The Act incentivizes them to issue and custody stablecoins, leveraging their regulatory expertise and infrastructure. Meanwhile, decentralized protocols are sidelined. Critics argue this isn't about innovation, it's about control. The law's silence on par price, the one-to-one peg between stablecoins and fiat, is telling. Without clear rules, stablecoins could depeg, triggering market chaos. Yet the Act avoids defining this, leaving room for instability. Is this the genius of the Act? It positions itself as a win-win for crypto and traditional finance while subtly shutting out competition like CBDCs. But at what cost? By prioritizing compliance over decentralization, the law might stabilize the market or strangle its most disruptive potential. Here's a question for you. Should stablecoins be regulated like banks, or should they remain wildcards of the digital age? We want to hear your take. Is this law a lifeline for crypto or a straitjacket? Share your thoughts in the comments.